Ed Boyd this week sat down with Kerry Craig, Global Market Strategist for JP Morgan, and just started by asking about the dilemma facing the Reserve Bank in setting interest rates right now.
Well, I certainly think it's a pleasant surprise for everyone, the economy and everyone who's feeling the pressure of those inflation rises. The important thing about that inflation number was below what economists were thinking of. If you look at the consensus, it was below what the RBA had their own forecasts. So it's a very encouraging sign that there is those disinflationary pressures coming through in Australia, and I think it will give the RBA a pause for thought, given we have had quite an accelerated pace of rate hikes over the last 15 months or so. Well, we do think the RBA will continue to hike rates. We do think they will go again next week when they meet. It will be the last one for this cycle because it is clear that those pressures around prices are starting to come down. However, when the inflation number is still at 6%, it's still well above their target, and I don't think they can sort of ease back just yet as they wait for those numbers to really come through in the next few months to really show that inflation is going back towards their target.
Yeah, and how much of a concern do you think it is to the Reserve Bank with unemployment at 3.5%, obviously generating a lot of pay rises in the economy right now and supporting consumers and adding to inflation, really?
Yeah, well, that inflation number being above wage growth means that, in real terms, wages aren't rising as expected. But, it is, again, we think about those inflation numbers coming down, the wages going up a little bit. It will support the consumer to a degree. I think there's still an element of thinking about the inflation pressures being a little bit more sticky here than we've seen offshore. Obviously, we're looking at the housing market closely in that degree and how rents are moving. We're thinking about some of the utility prices, which take a little bit longer to feed through in terms of spending patterns and are priced off where inflation was, not where inflation is going. And so there will be still that squeeze around consumers. So I think that even with wages going up, we will see that spending level in the economy continue to be curbed a little bit. And again, that's what the RBA wants to see. That's why they increased rates. They want to pull back on that discretionary spending. However, it is all about whether they do too much at this point and whether that does have a negative outcome for thinking about curbing spending, curbing activity too much, and actually creating that recession, which we don't think is needed to bring that inflation rate back towards that 2 to 3% target.
Yeah, a few months ago, a lot more people were talking about the possibility of a recession for Australia, but it seems like those concerns have been wound back a bit. What are some of the things that might have changed over the past few months that have changed those sort of thoughts?
We were never really looking for a recession in the Australian economy. It seems to be the exception rather than the rule when you look at the history of Australia and how it's performed. And we looked at mainly looking about the increase we're seeing in net migration. More people in an economy, that'll go to easing some of those pressures around the labour market, addressing some of the concerns about inflation expectations getting unanchored and wages going up too much, but also creates a broader aggregate demand in the economy. It does mean that your economy should be growing, and we'll actually do see the fact that the Australian economy can continue to expand. However, those numbers aren't going to be at a level that probably feels like we're in a booming part of the economy. We're not thinking about growth rates that are going to be really where we are in terms of the potential for the economy. So it's still going to be quite a subdued outlook over the coming 12 months while those interest rates remain relatively high.
So cash rate peak in Australia, you're pricing in 4.35?
Yeah, we think next week should be the last one from the RBA. We think that they'll be happy to wait and see those numbers around inflation continue to fall. It'll be whether and how fast they come down, which I think really dictates whether the RBA will do more than that. But I think the big difference right now is that while interest rates have gone up a little bit more than we had expected, the difference now is that markets aren't really thinking about rate cuts anytime soon, and that the RBA, like many other central banks, will be entering into this protracted pause of keeping those rates higher for longer.
Yeah, you look overseas this week, US Federal Reserve lifted interest rates again. So is there a bit of a shift now in market thinking? They're not worried about how high rates are going to go. They're worried how long they're going to stay high.
Yeah, you've seen that pricing for the terminal rate, or where interest rates are going to end, come down in terms of market expectations. And I think there's a degree of comfort around that being reflected if we look at the behaviour of bond and equity markets and how they think about that, unwinding those expectations of rates that go to 6% we saw a few months ago when those inflationary forces around sticky inflation were more prevalent. But again, it's the pricing of rate cuts. When interest rates stop going up, immediately, market participants start thinking about, well, when are they going to come down? And that's where the caution comes in terms of pricing that too soon. When inflation is moving in the right direction, but still isn't at a target of any central bank around the world, and we're still not exactly sure, how persistent it will be, given a lot of the disruptions we've seen over the last couple of years in the structure of economies.
Yeah, looking globally, obviously recession unlikely for Australia, but what about some of the other big economies like the UK and the United States?
Well, the US is the main one. We're thinking mostly about the potential for a recession, given how fast, again, rates have come up. You know, look back at history, you don't put interest rates up by 500 basis points and think about not having a recession, but it does seem that that very narrow path for a soft landing in the US is actually getting wider, that there's a bit more of a balance around the two-way risks in the economy. And again, this week from the Federal Reserve, what we didn't hear too many changes in what they were thinking. One thing they did note out is their own staff forecasts are no longer for a recession in the US. And we think the case of a recession versus soft landing is much more finely balanced. And if anything, we can see reasons why the economy may skirt around a near-term recession. Eventually, the economic cycle comes to an end. You do get that recession coming through, but that is definitely going to be more of a debate for 2024 than 2023.
Looking at the Australian stock market, it's only roughly 3% below its peak from August 2021. Are there some areas of the market that might be overvalued right now?
If we look at the index level as a whole for the ASX 200 at the moment, it's about average. It's a little bit above its long-run average, so we can't say the market is looking excessively overvalued. And that's true for many other parts of the world. If we look towards Europe, for example, or even in Japan, where you are seeing pockets of excessively high or elevated valuations, that's where you see some of the enthusiasm around the tech and the AI-related names, which really have driven a large part of the rally in the US, and to a lesser extent what we're seeing here in Australia. That does create some concern. We think about, is it becoming overvalued? But it also creates an opportunity, given that you have a wide dispersion between the companies that have done very well and those that have lagged behind. And I think if we do see better economic momentum come through, that rotation within equity markets towards those catch-up sectors could start to play through. So being very active in this market is what's really key.
And looking across to China, economic slowdown there, potential for deflation in the economy. How big a risk is that for Australia?
I think it's a very different case in terms of China being counter-cyclical. When it slows down, you get a big fiscal stimulus. That's a positive impact around the region. Obviously, has a creative positive impact. We think about the impact on the resources sector and how the market performs. COVID interrupted what was going to be a very long-run deleveraging process for China. They're going back to that process around deleveraging. They don't want to have those really large fiscal stimulus packages. They're really trying to shrink the size of the property sector in terms of its size of the economy, and that's why they haven't had any big policy announcements. We have had more encouraging news this week around the targeted measures they're likely to announce in terms of easing some of the stress around the property market, maybe addressing some of the concerns that have come through in the local government debt side of things. And that does mean they're probably on track to achieve that 5% growth target that they outlined this year, but not much more.
Kerry Craig, Global Market Strategist at JP Morgan. Thanks so much for your time.
Thanks, Ed.